everybody after the webinar. Without further ado, we will get started talking about credit risk today. So credit risk is one of those things that pervades most aspects of corporate life. You know, we're fortunate to have people attending from major corporates, infrastructure providers, fund managers, and credit risk will impact all of us in various different ways. So if you're placing money with the bank on deposit, then you've got credit risk. If you are lending money to somebody, you've got credit risk. If you're buying securities, debt securities from issuers, you've got credit risk. Counterparties for derivative trades, same thing. You know, they're what I'll call explicit credit risks. And then we've got what I'll refer to as implicit credit risks. So this is where, you know, I might be paying for some goods, but I might be buying some goods, but payment won't come back until later. It might be where I've got a complicated financial transaction and there are payment institutions in the middle. It might be where I'm dealing with central counterparties or exchanges. And then there's a third level of what I'll call indirect credit risks, where actually it's not certain at all that I have a direct credit exposure to the party in question. But if, for instance, that party were to have a credit event, that would materially impact my business. So this is the case where we've got service providers or other folks who are supportive of our business, so suppliers in our supply chain, for example. So credit risk really is pervasive in many aspects of our lives, but at least in my experience, it feels like people often underestimate it. Often too little thought's given about it until too late. You know, you can question whether that's because we've just gone through the most benign credit cycle with 10 years really very little happening from a credit perspective. Maybe it's because many of the folks who do remember the last crises, whether that be 08 or 2000 or 98 or 94, many of those folks have retired, and so they're no longer around, and we've lost some of that collective experience. But for whatever reason, you know, personal opinion is that credit risk is poorly understood and poorly quantified. But very fortunate today to have two people here who definitely don't underestimate the appearance of credit risk, in Mark Faulkner, the co-founder of Credit Benchmark, the owner of the largest credit consensus data set in the world and another financial technology company, and our very own Henry Adams, a chief product officer and I don't know if you get offended if I call you a veteran, but a veteran of the repo market, and somebody who's been around this sector for a long time and is at the coalface of looking at credit, both in good times and in bad. Before I get the two of you to introduce yourself, I should just point out for the audience that this is indeed Mark Faulkner. It's not an imposter if you were looking at his photo earlier. The real Mark Faulkner apparently isn't sat in a chest somewhere in the background while this is somebody else who's running around the internet doing webinars. But yeah, I think so. This is obviously a newish look for you, Mark, inspired by lockdown. I hear you've had some comparisons to Tom Hanks and others as a result. Maybe if the audience can think of any other likenesses, they should post them on the chat, and we'll post them around at the end.
Yeah, Tom Hanks in Castaway, I think specifically, Kevin.
Yeah, so Mark, if you wouldn't mind, I think there's a bit of Albus Dumbledore in the beard personally, but anyway, if you wouldn't mind just introducing yourself for everybody, and then Henry, perhaps you could do the same.
Thank you, Kevin. Good afternoon, everybody. It's a pleasure to join what I hope will be an interesting and engaging conversation. Thank you for the invitation. My name is Mark Faulkner. I'm the co-founder of Credit Benchmark alongside my business partner, Donald Smith, who I've worked with since 2008. An auspicious year, which was the last time we had a global crisis of any massive scale in the financial markets. We decided in 2012 to build a business together called Credit Benchmark. Credit Benchmark creates a consensus rating that delivers the real world credit views of major financial institutions with skin in the game. And we did so and launched that service during the most calm, most benign period of credit the world has seen for a very, very long time. But we were able to grow that business, and we launched the service in 2015. We've grown to 37 contributors, and some of the data that is now being produced will be the subject of some conversations. We're pleased to share the data that we see in an aggregated and anonymized way with TreasurySpring and the audience today.
Thanks, Mark. And Henry, if you could do the same.
Yeah, sure. So Henry Adams, Chief Product Officer at TreasurySpring. Welcome to you all. Thank you for joining, and thanks, Mark, for sharing your insights and your data and your wisdom with us today. So my background is, as Kevin's alluded to, the repo market, so both on buy and sell side financial institutions. I was there in the last crisis at the Royal Bank of Canada in the capital markets division, extending credit to a range of borrowers, including those investment banks that sadly are no longer with us. My role at TreasurySpring really covers the origination piece. So looking at how we deliver product that's going to be interesting for our client base, offering those better risk-adjusted returns that we all seek, and finding those safe homes for cash.
Thanks, Henry. So, Mark, this is the second time you've built a business. You did it once with Data Explorers, had a nice exit, could have sort of wandered off into the sunset and spent time semi-retired, keeping a hand. Why did the world of credit data strike you as an area that was so compelling that you should turn your back on comfortable retirement to go and build another business in it?
That's a great question. Realistically, there wasn't an option for me to stop. The wife and the children wanted me out of the house, which is somewhat ironic, as I now sit in the house all day doing credit benchmark work. I imagine the entire world is now sort of fed up with the term working from home and is probably more comfortable with the concept of sleeping at work or living at work. It is a very, very strange world we live in. We've witnessed the entire world of the credit crunch happening around us. We were part of, a financial technology company at the time. We had real issues to deal with, like at one stage, being very close to an Icelandic bank that was providing leverage into the business, which we fortunately replaced with HSBC just in time. We'd seen the paucity of actionable, credible credit data in action in the marketplace. We'd seen the dominant incumbents and their issuer pays model being challenged on a number of different fronts, not just by the practitioners, but by the policymakers and the regulators. We'd seen the way in which, say, Dodd-Frank legislation had encouraged American banks in particular, but there were similar regulations elsewhere encouraging banks to do their own credit assessment. It was for good business reasons and these policy and regulatory reasons that the industry was looking to do the work themselves or to try and find an alternative. Our previous business at Data Explorers was a contributed database business model by which we gathered data from participants within the market, aggregated securely, consolidated, and played back to the contributors en masse so they could learn how their view coincided or did not coincide with that of the marketplace. Credit's quite a lonely business. And so doing that work in your own bank or organization, it is useful to have a credible benchmark against which to compare yourself. And we thought that it would be helpful to have such a benchmark constructed by the buy side, organizations with skin in the game, rather than against a issuer pays model. As I said, we'd enjoyed some success with that business model in Data Explorers. And with what we like to call the confidence born of naivety, we thought, well, let's go and try something similar within the credit space. So two things happened. We started going to see the chief credit officers, the chief risk officers of some of the largest banks in the world. And the conversation went something like this. Hello, you don't know us, but we've been introduced to you by your head of financing, head of repo, head of prime brokerage, who can vouch for us as good guys who've done something very valuable with them. What we'd like to do, if it's okay with you, is take the outputs of your regulated models, your probabilities of default on a forward-looking through the cycle basis, so we can amalgamate them into a credit benchmark, which you might find useful. Well, the conversation went something like that, and then the answer was very, very often, don't let the door hit your ass on the way out, because they'd never been asked for this. Only the regulators had seen this information. So over time, we built the credibility. And in 2015, in May, we decided to publish data because we had 350 names where 5 of the contributing banks, where 3 of them were overlapping on individual LEIs, counterparts with whom the banks had credit risk. and we were able to publish 350 consensus credit ratings. Of something, the journey is still going, but that was the kernel from which we actually have grown the business. We've now got 38 banks contributing data and approaching 50,000 consensus ratings available, which compares very favorably to the 15 or so thousand individual entities that the credit rating agents, the big three, Moody's, S&P, and Fitch, rate. So that's what we did. The challenge was something we thought would be easier to crack, perhaps, quicker to crack, perhaps, than we have managed to do it. We've kept with it, and we're here to, to share what that data can tell in answer to some of the questions that you may have later.
Yeah, thanks, Mark. And as you know, I've been a big fan of Credit Benchmark from the first time that I heard about the idea. I think you described it to me as, you'd sort of done that magic trick that Uber have done with taxis and Airbnb have done with real estate, which is that you're the largest credit rating agency in the world now without holding any credit analysts as part of your staff. Henry, do you want to talk quickly? We've been a happy subscriber to Credit Benchmark for 3 or 4 years now. Do you want to talk a little bit about the value that we see in the data and why generally we think it's a good idea to be looking at alternative sources of credit like Credit Benchmark right now?
Yeah, sure, absolutely. So historically, the methods you'd use to assess a counterparty, would come from your credit department, of course, but then, as a trader, you need to make your own assessment and you build tools to help you in that process. And so you'd be looking at stock prices, you'd be looking at credit default swaps. So, they're the price to insure against a default. You'd be looking at credit spreads, you'd be looking at sectors, etc. But what you wouldn't have, and of course the credit rating agencies and those ratings, and I'll talk about that later in the webinar, in terms of how useful they were in the last crisis. But in terms of having something like Credit Benchmark where it's unbiased, it's being done by people with skin in the game. It is crowdsourced, and there is wisdom in those crowds. They are paid to ensure that the bank doesn't lose money, as opposed to paid by an issuer to give them the rating they desire. The frequency of the data as well is exceptionally useful. With traditional ratings, you're very much backward looking. It might be quarterly, it could be semi-annually, it might be yearly. Having something that's monthly, that is forward-looking and thinking about the probability of default in a far shorter time period, being a year, all of these factors when thinking about risk are tools that I really wish I had last time around, whilst we did come out pretty well, in fact, at the Royal Bank on the repo desk. Many didn't, and a tool like this would be something in the toolkit that would have been super valuable, and it's great that it does now exist for all of the reasons I mentioned. And I'm not here to plug the product, but merely highlight the fact that as an additional tool to give you that oversight and really think about risk and use all the information you possibly can and leverage off the expertise of all of those banks and those professionals is very powerful, along with all the information that we get from markets, which of course is incredibly valuable as well.
For us, go on.
Can I just join in there? I think one of the things we're keen to do is to see how different types of information, as you just said, Henry, fit into the sort of armory of anybody who has the daunting responsibility of risk managing in these very difficult times. One example where we've seen our data being used in a way that we just didn't ever think it would be. So shortly after the crisis really began to hit, we got a call from the Bank of England who said, "We've heard that you have some data that might be helpful in our COVID planning and thinking, and pleased to take the call." And within 2 days, we were providing data to the Bank of England, Her Majesty's Treasury, to help them make decisions as a part of a suite, Henry, to your point, and part of many different things that they're looking at, to help them make liquidity decisions that became solvency decisions that impacted the survival of companies, the survival of jobs on an ongoing basis. And for us, that was really unexpected, but exciting. We're very proud to have been of service and continue to be in that particular way. But it does show stressful, unusual times, information can be used in a variety of different, slightly unexpected ways. The support on the CCFF, the COVID commercial funding facility, was totally something that, well, it didn't exist before March. And sometimes you can just get drawn in different ways. I'm sure you find that in your business too, that you're doing things now that you hadn't imagined that you would be doing, when you first started.
Yeah, and I think sort of a common thread across our business, your business, other tech businesses is that it's part of a suite of solutions, and certainly the treasurers we talk to, the people who use us, we're not the only cash management tool or system that people use. We like to think that we might be the best, but we're not the only. And so it's trying to make sure that our clients have the right tools at their disposal in order to make the best decisions that they can. And for us, using Credit Benchmark, obviously we are managing a cash platform, and so for us it is crucially important that we have great visibility, not just on our counterparties, but also on the market as a whole, and try and make sure that we understand the credit dynamics that are going on, such that we can, it's impossible to predict the future, but you can do a hell of a lot better if you pay attention to the data and you look at everything that's out there, rather than burying your head in the sand. And I do have a feeling with credit sometimes that people do. So on that, maybe if we just move on to looking at what sort of shape the economy was in coming into COVID, and from where we were. Now I'm going to try and talk and share my screen at the same time, but as my wife will attest to, multitasking is not my best skill. So if I get it wrong, then apologies in advance. Also, I won't keep the slides up here the whole time, because I think it's probably a little bit easier for people if they can see us talking, but we will, as I mentioned, send the slides around after, so don't worry too much. So Henry, do you want to talk a little bit about maybe these two charts? So you've got here the IMF World Economic Growth projections as they were in January. And if I roll them forward, you've got what they were in June. Now, they're quite different if we just move from one to the other. And Henry, do you want to just talk a bit more around what you were seeing, what we were seeing in the market from a credit risk perspective? I know since you and I have been talking for the last 3 years, we've both been sort of agreeing we might be late cycle from a credit perspective. So fair to say that you thought we were very late cycle by the time we got to March?
Yeah, I think so. And look, some of the dynamics and the way the market was meant that the credit cycle in many ways has been prolonged. There being interest rates being kept lower for longer, plus all the various stimulus packages since indeed the last crisis, and QE still a thing, bond buying programs, etc. So keeping the price of money very cheap. And so what concerned me back in 2017, more so today, is just the scale of debt that is out there. Since 2010, we're talking about a doubling of corporate debt. Not just this, but it's also the flavor of debt. What's the rating of the underlying? We've also seen a shift. So more paper and then lesser rated paper. So, we're now talking about a world where, that BBB, just about investment grade threshold is 51% of outstanding debt globally. And a further 25% is sub-investment grade. Now, sub-investment grade is an interesting term. It was known as junk, speculative grade, high yield, whatever you like. But the idea being that, it is speculative in nature. So a lot of the debt that is outstanding now, it's far greater. And the underlying rating is, of course, not fantastic. We've seen an erosion.
Yeah, absolutely. And so, I won't go over the details of what's happened in the world since March. Everybody's infinitely familiar with terms like quarantine and lockdown and social distancing and bubbles and all of these things, which were words that entered our lexicon only in a very different way pre that. But what we have seen, of course, is central bank intervention, which we spoke about a little bit for those who came to our last webinar, on the greatest scale in history. And to look here, this chart's showing you the black circles are the levels of financial support provided to markets in various different forms by the countries that are set out during the 2008 financial crisis. And the big blue bubbles are the levels of central bank stimulus that are provided by those same central banks in the COVID crisis, so just since March of this year. And so the slightly terrifying thing is you can see that it's not just a bit bigger, we're talking orders of magnitude bigger. Henry, can you talk a bit about the effects that that's had on markets? Obviously, the purpose of the central bank's support was to step in, obviously to provide support to real world and to get money in the hands of people that need it and to prevent job losses and what have you. But if you could just focus a bit on what it's done for markets and particularly the credit markets.
Yeah, sure. So absolutely. One thing quickly on this chart is that, of course, when looking at the financial crisis, that's something that's now for the history books. We're still in the pandemic. Every day we're hearing about the fact that policies are being extended, broadened, potentially more targeted. But the idea is that, look, there's more debt still being printed at unprecedented rates. The reason for this stimulus is that essentially in March, markets were in meltdown across the board. We had a huge sell-off in stocks, risky assets, being particularly, those credits that we've discussed in terms of this large volume of paper that is speculative grade in nature and, returns uncertain. And so the level of support that's been put in has been to really try and get a floor on this. Such a broad range of measures. I mean, in the US alone, it's several tins of alphabeti spaghetti to list all of the acronyms that are out there. For those that are interested, I've posted on it in LinkedIn. I'll add the link at the end of this webinar when we send out all of the information. But essentially, this huge swathe of support had to come in. And what's that done is give markets confidence. So where is this reflected? The NASDAQ year to date is now currently up 16%. That doesn't really look like a world where in the midst of a pandemic with no real end date. That's one extreme, but certainly stocks generally recovered. What we've seen in government bonds is, we certainly saw that flight to quality. Interest rates have been cut, and this support has also hit credit markets. And so, in the US, the buying of junk bonds. In Europe, likewise, the buying of junk bonds, albeit that their measure was to say, well, debt that prior to the pandemic was investment grade. In the UK, of course, we've had bond buying programs that have been extended and expanded as well to hit the corporate sector. And what this has done, of course, to pricing is to calm things down, because essentially what we saw were huge stresses with regard to the pricing, even in the front end in the money markets. We saw a liquidity crisis, and what we know from previous experiences that liquidity crises can very quickly become solvency crises. So all of these measures have been done to make sure that we don't face an immediate solvency crisis. But of course, what it's done is create a rally in credit. What do I mean? Well, essentially, by providing that security net, everybody feeling confident in buying that debt. And so it's almost like a risk-free bet. That's how it's being perceived currently in the market. But of course, look, the economy is deteriorating. We're seeing revenues being hit. We're seeing the ability to repay off the back of that being hit. We'll talk more about fallen angels shortly. And so you've got, the two-pronged approach. Whilst this stimulus has come in and pushed prices higher, the fundamentals haven't really improved.
No, I mean, from my perspective, I've posted a bit on LinkedIn and talked to anybody who's willing to listen about moral hazard and those sorts of things when you get central banks buying junk bonds and arguably distorting markets. And you could certainly get to a world where if you wandered into the credit markets today and sort of poked your head around, you might think everything was just fine. And as you say, I certainly don't think that you'd believe that we're in the midst of a global pandemic where half the world's just been shut, or more than half the world's just been shut for months on end. I don't know, Mark, you mentioned that you set up credit benchmark in a very benign credit environment. Have you felt in your conversations with clients and your requests from clients, are people focused on this? Are people more focused on this? Are you seeing new, different requests for data? Obviously, the Bank of England was very focused on it and found your tool extremely useful. What about other use cases, other focuses that people have got as they come and talk to you?
Well, I think if you listen hard to the people you're talking to and your customers and your prospects, they'll tell you what they want. And what people really want is as much information as they possibly can that they can understand and action. So that kind of is almost tautological, really, to some extent. But one thing we've had to do, or not had to do, chosen to do, was to reduce the latency of the production of the data. What I mean by that, normally we'd be process, or we'd be taking data and cleaning it up through the course of a month and then take a couple of weeks to process it. That could mean that some data might be as old as 6 weeks old. We've reduced that latency period by basically saying, give the data by the 10th of any particular month, we'll turn it around in 5 days. So it's published in the middle of the first month rather than the middle of the next month. So it's a month quicker, the publications. And then we run the process again. So frequency is doubled, latency is halved. To to Henry's point earlier on, the speed with which data is available is very important. Why? Because the world is transitioning really quickly. The acceleration of credit transitions across the world, across the economy, in the real world economy, is accelerating. And certainly the banking data that we're seeing, it means that the banks are again faster than the credit rating agencies because they have a different motivation to look at creditworthiness. And here in these slides that you're showing, so it's a global picture. These large corporates in the United States, the United Kingdom, and Europe, and you can see that benign picture that we're talking about, but a very, very quick response from the banking data, showing how important it was to them to start really looking at the real world deterioration in creditworthiness. Remember, with skin in the game, your preoccupation is return on capital, of capital. You have a concern, obviously, about your business and your relationship with your customers, but your first duty is to try and protect your organization. So the data did respond very quickly, and we were pleased to be able to reduce that latency and increase that frequency.
Yeah, and I mean, so looking at this data, as you say, so this is from your aggregate, so from your 50+ thousand observations,
Yep.
But the subset of that is in the large corporate sector across these 3 major geographies. And you can see all of them are down. US significantly more down than Europe and the UK, but even Europe and the UK down 7 to 10%. What does that 7, 10, or 18% represent in terms of the scale of drop? Is that how do you calibrate those percentage numbers?
Well, that would be the percentage of the entities in that aggregate in total. I couldn't tell you off the top of my head. Happy to follow up with some details on the follow-up documentation as to the scale of the aggregates, the number of companies in those individual aggregates. But X% of them, 7% of them in the case of the European large corporates, deteriorated dramatically in that period.
Okay, that makes sense. And what's interesting here is, I think we'll probably talk about types of credit and credit transitions in a bit more detail shortly. But if you look here at where the ratings are concentrated, you've got huge swathes of the market in BBB, and then also down into BB. Not that much of it. Hardly any of the world's debt is AA even these days. Most of the banks don't make AA ratings. Certainly not that many corporates, and not that much single A either. If we drill down a little bit more into the worst affected areas of the markets, I guess these are not surprising in that you've got anything in hotels, travel and leisure, automobile parts, and you've also got general industrials in here as a poor but not quite such poor performer. But you've got 150% deterioration here in United States hotels. Again, looking at where that concentration is, all in that BBB, BB. So this is already speculative grade debt. Yeah. And then if we flip through Europe, same picture really. If you look at the scales, it's not quite as dramatic as in the US, but still pretty significant decreases, still pretty high concentrations in that BBB, BB sector. And then the same picture in Asia, again, similar to Europe in terms of scale, and again, similar in terms of the credit metrics. But I think, one of the things that is worrying to me generally is that normally when you get crises like this, there's somewhere to hide. It's pretty rare for us to see industries across the globe and across multiple different sectors all being affected all at the same time. And maybe we'll talk a bit more about CLOs and what have you in the future, and correlation and concentration limits in those. But yeah, I don't know, Henry, in terms of how you see this progressing and how you see that sort of that huge concentration of what feels like a horrible tide all moving in the same direction, what dynamics are you seeing panning out in the corporate sector, and what do you look for the future?
Yeah, sure. So, part of the effect of the central bank stimulus that's come in is that everyone's realized, okay, look, markets look calm now. Good time to shore up my balance sheet. So more, and whilst in the short term, that's great because it means that everybody's solvent. It feels a little like the world is betting on a hopefully not V-shaped recovery. I think we can forget about that one. But essentially,
No, I don't know if others have lost Henry, but I appear to have lost him, at least momentarily.
Whilst
Yeah, please do. Yeah.
To join. On the charts you've just shown,
I can see everybody.
Henry, welcome back.
We lost you there for a second, Henry.
Thank you. Okay, apologies. So look, balance sheet resilience is obviously key. At the moment, increasing levels of debt, there will be winners and losers. It's inevitable. Not everybody can be saved from a company perspective, from a job perspective. And so there is going to be, unfortunately, somewhat of a reckoning of sorts. We obviously need to see demand return, but we're seeing that demand in some instances simply won't return for really many years. Whilst interest rates can't go up for a long time, what I do think will happen is that there will be a return of the credit premium because there simply will need to be further impairments to come, meaning that actually you need to price risk correctly. Why do you price risk? Well, if you think about it, even from an insurance perspective, you need to raise premiums so that when there is a payout, the money is there, and it's the same sort of mentality that should be taken when it comes to credit risk. In that you need to have a buffer. You need to be rewarded for risk that has been lacking.
And Mark, you were gonna share some thoughts too.
Yeah, a couple of things. We've looked at sort of large corporate charts in recent moments ago, and I think the point I would make would be that the large corporates have access to bank lending and bank information, but they also have the public markets to go through, and those are the kind of instruments and securities that are issued that our audience might be buying. But there's another very, very substantial part of the marketplace that is in real difficulty. And the small and medium-sized industries in the UK and elsewhere around the world are in great jeopardy for a whole host of horrible reasons. And they weigh very heavily upon the banking sector and the financial sector because that's where they typically get their funding from. So I think that that's an area to be very sensitive about. Not just industry sectors, but the scale of the enterprises operational within those sectors. I think another thing that I would say is that we've certainly noticed that the regulators of the world and therefore their banks have taken a slightly different approach to the dealing with of impairments in their books and records and their accounts as they go through the quarters. American banks have a higher propensity to throw the kitchen sink at it as they've been encouraged by their regulators. Why? Well, because it's prudent, and two, because of the capital strength relative to the rest of the world. The American banks can take it. It's less of an issue, less of a comfortable issue for the European and Asian banks. And so we're seeing a genuine fascination with the level of impairments, the extent to which some of them may be written back, but there's also fascination with the benchmarking of those impairments, where you're dealing with International Financial Reporting Standard 9 or CECL under regulations. The banks and the people that buy banking shares and who have exposures to banks need to be very sensitive to the way that they are looking at their impairments. It does seem as though many of the banks have been able to I wouldn't say brush them off in any way because the numbers are so large, but to be able to compensate for these losses by earnings. And they're not really eating into capital. Many of them are not yet doing that. But I wonder how long this process can continue in a real world economy where they have to start, writing off and taking impairments from real world, smaller, medium-sized companies before they start breaking through that earnings capability to cover the loans. and the impairments and start eating into capital. I don't think any of them are really doing it yet, but that's one to watch.
Yeah, and I think the banking sector is a really interesting one, obviously, because people are talking about this crisis and saying, well, first of all, they said it was a medical crisis. It's not a markets crisis. Then they sort of realized, well, yeah, it's a markets crisis, but it's a corporate crisis, not a banking crisis. And of course, I think there's two really interesting things. One, as you say, is ultimately all of those corporates are being financed from somewhere. You know, we don't live in a world where most businesses are financed entirely by equity. And so those impairments are going to end up somewhere. And of course, the other thing is that banks hold credit instruments as part of their capital, as you point out. So if we talk about things like CLOs, which are effectively big pools of corporate credit, where the average credit in those CLOs is of junk bond level, if you start to see material credit events, which leads to material decreases in payments to the differing tranches of a CLO, and you start to see impairments on those senior tranches of CLOs, which are typically held on bank balance sheets as collateral, as that sits there on bank balance sheets, effectively providing them with the ability to run their businesses with the levels of leverage that they do. If you start to see impairments in those, then balance sheets need to be shrunk, ratios start to fall out of whack, and obviously then there is potential for us to see ourselves in a rerun of what we saw in 2008. I mean, on that, you know, a couple of charts here. One, we're looking at the banking sector across different regions, again from credit benchmark data. Again, interesting to note, you know, in the banks, we do have more banks in that single A space, definitely, than corporates. There are more there, but still lots in this triple B space. And then if something that you showed us yesterday, Mark, which I thought was really interesting, was this transition matrix for financial institutions. So if I may, if you could just explain what the data is, and then Henry, I'd love to get your views on, you know, how you thought about it when you looked at it.
Okay, so what we've tried to do here is on the horizontal, on the rows, just segment the banking sector and the intermediaries that one would typically recognize in the profile of the financial network. There is an additional section which is more about the buy side, which I'm glad to say is more benign and of a higher overall quality. So the type of the first column would be the type of organization we're talking about, be it central banks or CCPs with their underlying members, etc. Then we look at the consensus deterioration or improvement. These are not notch movements. They are where banks have in the contributing data set taken a more pessimistic or optimistic view. The 5th column was the key area you've addressed a little bit earlier on, Kevin, when you were talking about that jumping off point between investment grade and high yield. How many organizations in this network are making that transition? And then to the right is a profile of where they are now, where these different parts of this network rank, AA, etc. Matrix. What we have observed, and these are 2-week deltas, this is not month on month, year on year, quarter on quarter. This is in the last 2 weeks, we're seeing two things happening. One, as is probably no surprise to anybody on this call who spends any time in the world of credit, the transition is happening quickly. There is a lot of movement. And unfortunately, whilst there is two-way movement, there are some organizations that are doing better and showing improvements. However, the bias is to the downside. So this is a sort of temperature gauge, a heat map, for want of a better word, of how we're seeing the universe of different organizations grouped into clusters or aggregates. Obviously, from a individual organization's perspective, they would not necessarily deal with the entire universe. The risk managers, the investment managers are effectively sort of guardians of their own galaxy rather than masters of the universe or mistresses of the universe. But the idea here is very simple: to convey the pace of transition and to convey the direction of transition, to facilitate a conversation. If this had been produced in, say, let's call it sort of the last quarter of last year, predominantly white and green, now materially red. That's what's changed.
Thanks. And so, Henry, your thoughts when looking at this? I guess partially as relates to our world, but also more generally?
Yeah, absolutely. Look, it is concerning. And as we've touched on, but let me go into more depth, it's these thresholds that are of most concern. So, you know, where for most of the banks, really the threshold for gaining the sort of cheap financing they require, you need to be single A minus or better. And so forget about, for now, just being a fallen angel. Actually, you need to stay A minus or better to be eligible to sell your commercial paper, your debt, etc., into most of the portfolios that historically would finance you. Moving outside of that space, if you fall into triple B territory, it gets pretty lonely. The pool of available buyers it shrinks dramatically. And of course, with every notch downgrade, you have to pay a higher premium. Now, if you have to pay more to service your debt, naturally, you're going to be closer to default because your ongoing costs are higher. And this is you know, yet more concerning when you go from triple B into the sub-investment grade space. So, you know, as you move into sub-IG, what you're doing is just shutting off a whole host of other potential buyers for your debt. And with each move lower, what you're going to find is that people are going to be forced sellers of that debt that you've issued. And when you come to issue new debt, all of a sudden, of course, you've been repriced. People will look to the markets, they'll look at the credit data, credit benchmark, they'll have a look at that as well, of course, and they'll look at CDS, they'll look at the share price and conclude that, of course, they need to be paid more. And so, you know, these trends have several downstream impacts, not all of them obvious, but none of them particularly positive, unfortunately.
Yeah, and I mean, so I've just pulled up a chart on fallen angels, and I'll talk about the credit benchmark data that we're seeing here in a second. I think so far S&P have downgraded 34 companies from investment grade to sub-investment grade since the beginning of COVID. That's out of something like, I think I can see it here somewhere, 1,190 rating actions. There you go. So you can see already in July, S&P have taken 1,190 rating actions. They took 1,326 downgrade actions in 2009. So we are within 150 of the entirety of 2009 by the end of July, bearing in mind that the crisis only really started in March. So, you know, so significant credit moves from the agencies, but not huge ones from the perspective of fallen angels. I think there's 34 downgrades and 126 on negative watch from S&P at the moment. You know, Mark, I was astounded when I read the article that you guys published the other day that was, I think, out of 6,894 of your companies, which were investment grade in February, a whopping 578 or 8% of them have fallen to sub-IG from a credit benchmark consensus perspective over the last few months. And the chart we're showing here is the proportion of the sectors that have fallen down. So you can see here 35% of those in travel and leisure that were sub-IG, that were investment grade, sorry, have fallen to sub-IG, 20-something% of leisure goods, 20% of metals and mining. So, you know, not surprising the sectors at this end, but there's a big long tail over here. And basically, it's only if you're in telcos, electricity, or smoking that you seem to get away with it. But so yeah, I don't know, why do you think that?
Actually, I had a quick look at that data. Yeah, it looked like tobacco was a late entrant, and so there wasn't quite the same history from credit benchmark. I had a quick look at that. Okay. So it may well be a larger green line than on the graph. Sorry.
No, so I'm just going to ask, why do you think it is? Why is there this difference between, particularly, you know, we've talked a bit about why banks might react quicker and there might be a bit more skin in the game and whatever, but why particularly around this investment grade to sub-investment grade threshold in the corporate space? Do you think there's such a disparity? You know, you're talking more than 10 times as many companies from your data versus S&P, for example.
Well, and Henry did a pretty good job, and I think anybody on the call understands that if you go off this cliff from being investment grade to high yield, your whole world changes. It accelerates all kinds of things that you do not want to see. And I think that It's all to do with the sourcing of the data. If you get data from people who do have skin in the game, who are trying to protect their organizations, they are broadly indifferent with regards to the actual rating. What they're trying to do is to get to some sense of rating truth. And they are much less sensitive to this chasm that exists. And I think that it would be different. It would be understandably different if I paid you to rate me, Kevin, and you understood how difficult it would be if you took me into investment grade, and I would do everything I possibly can to persuade you, to provide you with evidence that I'm okay. And I think there would be a reluctance to push me over that chasm, if you like. And I think that's a very natural situation. And so, you know, we've all seen The Big Short, and I, you know, almost have nothing else to add to that. You very kindly put up a chart here, which I think is very fascinating. On the y-axis, what I've called perceived accuracy. On the x-axis, stability, which to some extent is what we're talking about, the stickiness of a rating, the lack of its transitionability, if that's such a word. Do forgive me if it isn't. I took this, I scribbled this down on a napkin at a lunch with a gentleman who worked at one of the named agencies on the slide, someone who had understood methodology. And I was asking him kind of the question you just asked me, why are the rating agency ratings so sticky? Why don't they reflect reality? And he said, they're not designed to. A rating agency rates a company and gets paid to do so that company can issue bonds and paper and securities of all kinds of different complexity and simplicity and all kinds of different durations. It is not in the interest of that company or the buyers of those securities, those issues, that the rating changes all the time. I can buy it, I can't buy it. I can sell it, I can't sell it. It's in the index, it's not in the index. It's acceptable, it's not acceptable. It's usable as collateral, it's not usable. That changeability, the transitionability is a problem. It's an impediment. Rating agency ratings are designed to favor stability. That's not a criticism, it's an observation of fact. Therefore, they are not necessarily truly to be designed to be investment vehicles. Most of the rating agencies of the world are nationally recognized statistical rating organizations, NRSROs, and are regulated by the SEC in America. And they are American. Why? Because under the Constitution of America, God bless America, you have the ability and freedom to express an opinion. And a rating is an opinion. And it expressly says, and it's certainly enshrined since 2008, that a rating agency opinion of the creditworthiness of an issuer that has paid them to make that rating is not something that should be used as a decision-making factor in investment decisions, which is extraordinary, but true. On the other hand, the CDS market, and Henry, I know you have a lot more experience in this than me, perception that the CDS market is a more accurate source of credit information. I would view it as a different source of credit information. Some people consider volatility and movement as to be a proxy for accuracy. I'm not sure that's correct. I think just because it moves doesn't mean to say it's accurate. I think that it's not just a pure credit indication. It's a hedging and trading tool as well as a credit measure, and therefore it can be somewhat corrupted. And there's also a lack of liquidity as that market is slowly shrinking over recent years. But I hope that answers your question.
Yeah, I mean, and I think it's really interesting, and I would add one thing to that, which is that I don't think as a system we've helped ourselves, in that we got these things called credit ratings, and everyone went, oh, brilliant! Now I can construct indexes on the back of ratings, and I can have stuff that sits into indexes, and then I can construct funds, and I can get those funds rated based on the ratings of the underlying constituents, and then everyone goes, oh, brilliant! I can now write my credit policy that says, oh, I just have this rating criteria in there. And so what we've done in a quest for simplicity, I think, is unfortunately built a system that is predicated on some building blocks that we call credit ratings. And if you pull some of those blocks away, the whole thing can really be rather precarious. And so I think it's, the regulators are trying, if I look at our little corner of the world and money market fund reform, what they tried to do after the last crisis was they said, we're not going to require your underlying securities to have specific ratings because we want you to do your own credit work and come up with your own credit assessment of these underlying securities that you're buying. What happened? The rating agencies turned around to the money fund providers and said, yeah, that's fine. But just so you know, if the securities that you buy aren't rated by us, we won't give you your AAA rating that you want. So we've found ourselves into this sort of slightly uncomfortable corner where the rating agencies and the ratings handed down by those rating agencies, whilst, as you say, they're nothing more than an opinion, really are uncomfortable cornerstones of the whole system.
Yeah, I mean, it's got nothing to do with credit, but the idea that the expression of an opinion that's, quote, not to be used for investment decisions are not used for investment decisions is crazy. It's incredible. I don't know if you're all familiar with those things that you might find in your kitchen drawer in the pharmacy, that with 2 bits of cotton wool at the end of a sort of plastic stick, earbuds, right? Well, what does it say on the packet? Do not stick in your ears. It's what everybody calls them. It's just because it says something on the packaging doesn't mean to say it controls people behavior. And I think you're right. The lunatics have taken over the asylum in some ways, and something that's deliberately not designed for purpose has been used as a foundation for a purpose.
So we've got a couple of questions from the audience. Before we do that, Henry, I just want to give you a quick opportunity to talk about spreads and CDS and from a market perspective. Anything to cheer us up?
Well, look, life goes on. We'll get through it. As long as we all keep safe and do our best. In terms of cheering us up, look, there's going to be prolonged low interest rates that'll have certain benefits. Policy measures, I think, will improve and become more targeted. We're going to learn more about the virus. Maybe there'll be a vaccine, maybe not. There are things coming. It's created a huge opportunity as well because the world has shifted so dramatically. And so, whilst, we've talked about fallen angels and the fact that, look, default rates are going to go up, this does leave space for others and innovators and incumbents to acquire, to expand, to grow, to create, start something new. And so, look, there's always going to be green shoots. And so, see some positives to come. In the meantime, I think, we need to be.
But so one more question for you, Henry. So
in the meantime, we'll just need to buckle down.
Quick question from the audience. So Goldman this morning have warned about concern about the US dollar status as the world's reserve currency. How worried should we be, and what impact might this have on credit risk? You've got 40 seconds to answer it, Henry.
Okay, sure. So for us to lose the dollar, we'd need to have a replacement. It's not obvious what that would be. I don't think it's going to be Bitcoin just yet. Some might say gold, but again, I don't think we're there either. With regard to credit risk, look, it's we're talking about separate things here. Then it becomes a question of, well, what's your dollar exposure? Are you domestic versus international, and what does that mean, for example, for what you do in FX and how you do business and how you translate that onto your sheet?
Thank you. Second question was, how do we, Treasury Spring, use credit benchmark data? Ultimately, we use it as a tool to supplement all of the other things we look at when considering the counterparties we face, whether they be sovereigns, banks, or corporates, and ultimately the risk that we pass on to our clients. So we use absolutely the underlying credit benchmark data as one of the tools. We are also looking at using credit benchmark data for companies that don't, in fact, have official credit ratings, but do have investment grade credit benchmarks. So we have a number of conversations ongoing now to be able to offer fixed term funds backed by investment grade companies, according to the people with skin in the game, the banks, their credit departments, but who might not, for whatever reason, have wanted to go and get a public credit rating. So, we're big believers in the model, and we think that hopefully there'll be more and more opportunities to collaborate going forward. And then final question I've got for you, Mark, which was, and I don't know if you know the answer, obviously we've started to see the first time since 2009, we've seen an investment grade company jump to default with Wirecard. And, it tends to be, the classic Warren Buffett, only when the tide goes out do you find out who's swimming naked. It's these sorts of environments where you find out the frauds and the things that might have been able to be concealed, sort of Ponzi style in good times. I don't know, how did credit benchmark data react to Wirecard? Was there any change in it beforehand? Was there anything interesting there?
Unfortunately, the banks were surprised.
Not surprising. I mean, it's a fraud case, right? Ultimately, it's very difficult to spot fraud. It's not really a credit issue.
I'd love to have said that there was a credit canary in the coal mine. No, they were surprised.
Interesting. Well, look, if we don't have any other questions,
maybe your whole business would have had more insight with regard to data explorers and fees for borrowing the underlying stock. That would be a canary to look for.
That did work. We work quite closely with IHS Markit, and the story of Wirecard is something that you could have picked up on the short side data. I wouldn't know if it was Jim Chanos, as he famously cut short on Enron at 64 and drove it to zero. I've no idea, but there were a lot of people short that stock.
Interesting. Well, look, that is all we've got time for. So all that remains is for me to thank Mark and Henry very much for joining us. Fascinating conversation. And thank you, everybody, for joining as well. We will follow up with a recording of the webinar and send around the slides. Henry's also kindly produced a sheet which has got details of a lot of the source data that we use to put these slides together, so if folks want to use it internally. And of course, if you've got any questions for us or for Mark, please just reach out at any time. There are details in the PDF that we'll send around.
Thank you very much.
Thanks. Cheers, everyone. Bye-bye.
Thank you. Take care.